The net income of a trust is defined in Section 95, subsection 1 of the ITAA 1936 as, among other things, the total assessable income, including capital gains, of a trust estate calculated under tax law, less allowable deductions. In contrast, the income of a trust estate is likely to exclude capital gains subject to what was in the trust deed. On the 4th of August, Smith & Co. Public Accountants completed the preparation of the annual financial accounts of the ABC Trust. These accounts showed that the accounting profit of the ABC Trust was $50,000. The trustee resolved to distribute the entire sum to Sam Valla, one of the primary beneficiaries of the ABC Discretionary Trust. On the 30th of August, Smith & Co. completed preparing the tax return for the ABC Trust. However, the net income of the trust shown in the return was $65,000. This discrepancy can arise due to a number of reasons, including items of assessable income treated as corpus under trust law or the trust deed. Expenses according to trust law or the trust deed are either non-deductible for taxation purposes or deductible to a lesser extent. Taxation law provides for special incentives which are deductible but not recognised as expenses for accounting purposes. The basis used for valuing trading stock or depreciating assets for trust accounting purposes is different from the basis used for income tax purposes. And lastly, imputation credits are included in calculating net income for tax purposes, but not accounting net income. Given the discrepancy of $15,000 in this case, how might the trustee and/or Sam be assessed? Where the taxable net income as calculated under Section 95 exceeds the distributable income, it remains to be determined under which section and to what extent the trustee or the beneficiary who is presently entitled and not under legal disability is assessable for tax. Two possibilities arise. Firstly, the beneficiary Sam is taxed on $65,000, being his share of net trust income. Or secondly, Sam is only taxed on the $50,000 received, since the trustee is not able to distribute any more than that sum, and the residue of $15,000 is taxed to the trustee under Section 99 or 99A. The problem centres on the word share in Section 97. Does share mean proportion of the net income of the trust or the actual amount? One view is that a beneficiary can only be presently entitled within the meaning of Section 97 to such amount of income as he is entitled or will be entitled to receive. This view implies that the word share does not mean a proportion, but rather an amount or an allocated amount. Taking this view would mean that the beneficiary Sam could not be assessed on any amount greater than the $50,000 to which he is presently entitled. This means that the excess would be assessable to the trustee under Section 99A, unless the Commissioner of Taxation exercises his discretion to apply Section 99. Support for this view can be found in a number of earlier cases. The Commissioner of Taxation will accept returns on the basis that once the share for the beneficiary is determined, the entire taxable income is assessed under either Section 97 or 98 as the case may be. The other view is that if the word share means proportion of net income, then the beneficiary Sam will be taxed on his share of the full amount of $65,000 Section 95 net income. This view assumes that the function of the first part of Section 97 is merely to determine the proportionate interest of a beneficiary in the income of the trust. And once this proportion has been determined, it is applied to the net income of the trust estate as calculated under Section 95. Consequently, each beneficiary is then assessed on his or her proportion of the net income of the trust estate as determined by Section 95, whether it be greater or less than the actual distributable amount. Accordingly, Sam will be taxed on his share of the full amount of the $65,000 Section 95 net income, and the trustee will not be subject to tax. To recap, remember, whenever there is a discrepancy between net trust income and the income of the trust estate, a proportionate view is adopted, meaning that a beneficiary will be assessed on their proportion of the net income of the trust estate, as determined by Section 95, whether it be greater or less than the actual distributable income.